But anyway, what I want to do today is I want to go back a little bit on the 3 non-QM loans that we have discussed just recently, because I have received in 3 weeks an enormous number of questions from y'all and others about those loans. And I thought, let me make some clarifications and some differences on those loans and where you can apply them. Because the most important thing is, how do you use this to market yourself? How do you use this to find another client? That's really what it's about. You know, as far as the program details, who cares? What you really want to know is, how is this going to help you? So I want to go back and just talk a little bit about the program details, then how do you use this to benefit you? The first one I want to talk about is probably the one that, in my opinion, is by far the most popular, and it's called the bank statement loan. Most lenders will call it a bank statement loan. And what it does, first of all, let's look at its purpose. Its purpose is to help those people who generally they have to be self-employed, but they don't show all the income that they really make. In other words, they might make $15,000 a month, but after expenses, it shows up at $5,000 a month because their accountant does a great job of writing everything off. Well, let's face it, at $5,000 a month versus $15,000 a month, you can't buy the same house. Now, even on the bank statement loan, if you're running $15,000 a month through your account, you're not going to be able to use $15,000. So I want to talk about that for just a minute, because it's a very popular loan. When somebody puts money into their account, into their personal or business account, whichever they're going to use, or maybe they're going to be using both. If they're going to do that, and they're going to run, let's just say they run $15,000 a month through that account. As a lender, on the bank statement loan, generally speaking, we're going to give them credit for 50% of that, which is $7,500 in this example. There are cases where we're going to give them more than 50% value. It depends on the nature of the business, how much of it might be, let's face it, if you've got somebody who's a contractor and it's just them, they probably don't have 50% of their expenses. They're going to keep more of it. In cases like that, we can use more. We simply have to document. But a rule of thumb is 50% of the income that flows through the account, which is a lot more than what most of them use, because I see a lot of the tax returns, and I see these tax returns with the revenue at the top line on Schedule C or their 1120S if it's a LLC, and there's tons of money in there. And by the time you get down to the bottom line, it's such a small amount. So the first thing is that bank statement loan, we're simply going to be looking at how much money is flowing through the account, give them a percentage of that, typically 50%, and that's what we're going to use for income. Here's the interesting thing about that loan. Interest rates are pretty good. I quoted somebody one on Wednesday of last week, and mind you, we gave them a rate. Now mind, a little bit of cost associated with it, but a 4% interest rate, with a 1% origination fee and 0.5% discount. That's it. I mean, that's not bad. I mean, and it's a big loan. I mean, we're talking about $800,000 loan. So when you compare it with jumbo rates, it's really not bad. So the bank statement loan is a very valuable product that I would be, anytime you talk to somebody about that's self-employed and they're a little nervous, they come up with comments to you that say, hey, I just don't know if I'm going to show enough income. I understand it gets real hairy. Say, that's okay. Let's talk to the lender, whether it's me or someone else, hopefully me, and whoever it is, but let's have them talk to them and find out how much money is actually going through the account so we can see what we could possibly do. All right, any questions on that one? That's the most popular. That one's getting a lot of attention. Yes?
Is there a length of time associated with that? For instance, a normal self-employment deal would be a year, 2 years.
Well, as long as they're self-employed for a year. Okay. But now here's the thing. The bank statement loan goes back, generally speaking, 12 months. So we have to show 12 months of bank statements. Now there's actually 3 different products. There's a 24-month, which means we're going to look back 24 months. Obviously, they have to be self-employed 2 years. We're going to look back 12 months. That's called the 12-month loan. And now we have one called a 3-month bank statement loan. We're only going to look back 3 months. They got to be self-employed for a year or two, but we're only going to look back 3 months. The problem with the 3-month one, it's much more strict on your credit score, and obviously the rate's going to be a little bit higher on that one. But that one can help, especially if somebody's had a tough year and all of a sudden everything's back to normal, because of loss of an account. There's all kinds of reasons, but it's a good product. So 24-month, 12-month, and 3-month. Good question, Trevon. Yes?
Would they be able to refi to a performing loan, after a certain length of time if they're on one of those products?
Yes, they can. They can refi into a standard loan. A lot of these products do have some type of a prepayment penalty on them. The bank statement loan, I don't think it does have a prepayment penalty. The investor loan does, the asset-based loan does, but I don't think the bank statement loan, I'll have to double check.
And is there any difference in time on those as far as time to underwrite and get it approved? And
right now, no, still about 30 days. Even though on that product, we don't do that product in-house, all right? But it goes so fast, and the two lenders that we use, it moves fairly quickly. So I would still say you're still looking at a 30-day, maybe a 35-day window at worst case. But they're moving pretty quickly. Good question. Anything else on that one? Otherwise, I'm going to move to the next most popular one, which is misunderstood, and I want to make sure we get it. It's for investors. And we recall we talked about it, the Dscr loan, which is the loan that we're only going to use if it's an investor. They got to put 20% down or more, but we're not going to ask them about their income. We're not going to ask them about their employment. We're not going to ask them about their income. All we're going to do is look at the rental. When we do the appraisal, we're going to ask the appraiser for what's called a 1007, which is a rental guide for how much the rents are going to be in that area. So if somebody says to you they're going to use it for Airbnb, we don't really care what they use it for. But as far as what we're going to use, what's the normal rental rate on that property? So let's say that you're buying the house and your new payment, after all in, your new payment, principal, interest, taxes, insurance, HOA, is $1,200 a month. If that's in fact the case, and the appraiser says, well, hey, rents in that area are $1,500, we're going to give you the loan. It's that simple. Credit scores can be as low as, believe it or not, as low as 600, which I can't believe. Interest rates go up if your credit scores go down, but any requirement for down payment increases if your credit score goes lower. Now here's what I was talking to two different people about last week. If they'll put 25% down, and they've got credit scores over 700, with both borrowers I spoke to last week have credit scores over 700. If they put 25% down instead of 20% down, we still have to get an appraisal, but we don't have to get the rental rate, which is going to save them about $175 on the appraisal and time, because now we don't care what the rental rate is. If they put 25% down, they got credit score over 700, we're going to give them the loan. It's that easy. Now, the interest rate's not for the weak of heart. It's going to be somewhere probably close to 5% with one origination and one discount point, so it's not cheap. There is a 4-year prepayment penalty on it that they can buy out of. Lanier, to your point, they don't want to keep that prepayment penalty because they want to get out of it. They can buy out of it. But, if you think about it, that's a phenomenal product. 2019, interest rates were at 5% on normal loans. Now you're getting a loan basically without having to qualify for it for 5%, and that's a great deal.
The buyer on that one will have to, verify, sign that they will not use it as a primary residence. It has to be.
Oh, yes, it has to be their investment. I'm glad you brought that up, Lanier. The only way we can do that investor loan for somebody is if they currently own their primary residence. They must own their primary residence before we can do that loan, because that absolutely is unavailable for primary residence. Yes?
Is there a minimum loan amount?
Yes, and if I'm not mistaken, I think it's $150,000 on that particular product.
Again, minimum.
For what, the bank statement loan?
Yeah.
Bank statement loan, 150.
Okay.
And if you have questions on it, I can always double check for you, but I'm pretty sure.
Are there any loan programs that go below 100,000?
The non-QM, no.
Okay.
The non-QM, nobody goes that low, not to my knowledge.
Maximum?
It varies from product to product. Some are 2 million, some are 3 million, some are 4 million. I'll have to check if you've got a specific need.
So if their credit score is over 700 and they've got the 25% cash, it's just a green light, no matter.
All we have to do is get an appraisal to show that the property is going to appraise for what you're paying for it, and that's it.
But not the rental assessment side, just.
We don't have to do the rental assessment. That's exactly correct, Lanier. What a fabulous way to go about getting property. If you've got a good credit score, you got 25% down, buy it. Done. Now again, a little higher interest rate, you're going to pay higher closing costs because you got origination fee, you got discount point, and you got the prepayment penalty on it, but who cares? Like the two people I talked about last week, they said, Greg, I don't care. I'm not selling the house. All I'm going to do is rent it. And I'm going to be getting more money than what I'm paying in. They're going to be paying for it basically anyway, so I don't really care. So it's a fabulous way to go about doing it.
Is there a maximum number of those that somebody can do?
Maximum number? No. As many as you've got the 25% down for. We do have to verify funds. Okay, you can't get gift funds. It's got to be, you got to have money. So, yep. But gee whiz, if somebody's got $250,000 put away that they want to use for investments, they can buy a bunch of property and get it done right away while they're competing with everybody else. Now, I know that doesn't always sound good because you're trying to get people into homes for primary residence, and you got these investors coming by buying up property. I know how tough that is.
It's fun to represent investors.
What's that?
It's fun to represent investors buying property.
Well, it can be, yes, Casey, I agree. I think it can be a lot of fun working with investors. Now, let's go to the third loan. The third loan is, of the three, it's probably the one you'll see the least, but it's also the one that probably makes people feel the best sometimes, and that is the asset loan. Asset loan is for people who've got a lot of money and they can't prove any income. And you say, well, how can that be the case? Well, I'll give you an example. I've got a couple right now, as a matter of fact, it was a lead from this office, and they're going to be buying property. They sold the business about 1.5 years ago. So they've got all this money sitting around, and they want to buy a house. It has to be primary residence, by the way. Can't do second home, can't do investment on this product. It's a $2.4 million property. That's not too shabby. Now, there's a whole bunch of things they only have to put 25% down, but they're going to put down 30 or 40%. So they've got to have the money for the down payment. Then they have to have enough money in the account after that for the balance of the loan amount, whatever that happens to be, in this case about $1.6 million, in addition to their down payment. Now here's where it gets a little bit tricky. Then we take their current monthly debt, their current monthly obligations. We multiply it times 60, 60. And that number they've got to have in assets as well, liquid assets. And then, go ahead, Lanier.
Is that on top of the money in account?
Yes, that's on top. Then we take the new house payment times 6 and add that, because that's called reserves. So they've got to have the down payment. They have to have the money in the account to cover the balance of the loan amount. They have to have basically 5 years of reserves for their current monthly obligations, and then they have to have 6 months of the house payment put in there. So you got to have quite a bit of money. So in this particular case, these people are buying $2.4 million home. They're going to get a loan for about $1.6 million. In order for them to be able to put this transaction together, they have to have about $3 million in liquid assets to be able to put that deal together. Fortunately, this couple's got a ton more than that, so I'm not sure why they even want a loan.
Yeah, why would you even want a loan?
Because the money's,
If their money's making more for them,
yeah, I mean, they're going to get an in somewhere in their case, probably somewhere around 4.5%, and their money is making substantially more than that.
Until Friday.
So why would they, that's why. That's a great question. Why would somebody do that? But that's why they do it. Because they're making a lot more money. If they're making 8 to 10 to 12, in some cases as much as 15, 18% on their money, then why not keep it working, and why put it into something here where you can get a loan for 4.5%? That's why they do it. So those are the three primary products. Now there's other products. There's foreign national products. You can do non-warrantable condos. There's products for people who only have an ID. There's all kinds of non-QM products out there, but the three primary ones that we are doing that I'm getting questions on are the bank statement loan, again, 24, 12, and 3-month bank statement verification, the investor product, which is again, what a great tool. I hope you'll use that. That is a great product. And again, most people that are getting it, they've got high credit scores. It's not like they can't afford it. I'm just not going to have to verify anything other than make sure that the property is going to qualify. And then the asset loan for people who've got a lot of money who want to take a loan. Anything else?
What do you mean by just an ID?
I'm sorry?
The ID, so you just.
You've got people who do not have Social Security. All they've got is a ID. There are loans to do those. I will confess, I have not done any of those, but I'm getting a lot of questions about it. And if for some reason you've got a situation where somebody only has an ID and they want to get a loan, you can come to me with it. It'll take me a little bit because I've got to get somebody who is an expert at it to handle it, because I'm not, we've got several people at our company who do it. I got to do a few of them before I feel real comfortable with it.
So in other words, a potential case would be somebody that's on a work visa in the United States and like to buy some real estate.
Well, if they're on a work visa, they got an H-1, I can actually do a loan anyway for them.
Okay.
Right. We're talking about people who are they're maybe not, yeah. Maybe not supposed to be here, and they got an ID and they want to get a loan. There's all kinds of things today.
I've got a buyer, the wife, I taught her in high school, and obviously she is an American citizen. Her husband came over when he's 2 years old, so been here forever. He's been working the same job. He gets the W-2, but I don't know, I guess he has a green card or work visa or whatever. But I went to Arizona, sorry, I didn't come to you. It's like
It's okay.
because of that whole zeroed in loan thing they have. And I talked to a friend of mine, another guy, I've been talking a lot, and both of them said there's no way to get a loan in America unless you have a Social Security card. So now I've got 2 couples that are exactly like this. So you're saying there is.
There is a possibility. Now, bear in mind, you still have to have an income that we've got to show. Right. We've got to be able to show it, but there are ways of doing those loans today that we didn't have a year ago. So if you've got a question on something of that, you can bring it to me. I will have to go to someone and do some further checking because I'm not an expert on those. There are people who are, and I'm not one of them. I'm also told that they are very tricky loans. That one is not going to be a 30-day loan. That's probably going to take a little bit longer. So bear that in mind. All right, any other questions?
I was just going to ask you if you have tax ID.
Yeah, because he works for
Yeah,
a
they can.
construction company that he's like a foreman or supervisor, and he has a tax ID, and he has another ID, and a Social Security card.
Any other questions? All right, thanks everybody, appreciate it.
Lost